Welcome to Private Equity Profits. Clifford Locks is a certified board of director, a trusted confidant to CEOs, C-level exec, and high-potential employees to help them clarify goals, unlock their potential, and create actionable strategic plans. Seth Greene is the nation's foremost authority on growing your portfolio companies with direct response marketing. He is the founder of the direct response marketing firm Market Domination LLC, and he is an 8-time best-selling author who has been interviewed on NBC, CBS, Forbes Inc., CBS Money Watch, and many more. Cliff and Seth interview top players in the financial sector, focusing on private equity firms, venture capital companies, and family offices, discussing developments and trends shaping the industry. These experts will share with you how they've grown their businesses and increased profit, and how you can too. And now, here's your host, Cliff Locks.
Welcome to the Private Equities Profits Podcast. I'm Cliff Locks, your host. With me today is Dave Seymour. After 16 years as a firefighter and a paramedic, Dave Seymour has launched his career, rapidly becoming one of the nation's top real estate investors. Within his first few years, Dave transacted millions of dollars of real estate and had become one of the nation's leading experts in both residential and commercial transactions. His unabridged passion for business and real estate put him on the radar of A&E television network, as well as multiple news organizations, including CBS, ABC, CNBC, Fox News, and CNN. The New York Times reported that Dave Seymour's series, Flipping Boston, posted the highest ratings ever for A&E network at the time of airing. Dave, welcome. You've had a very unusual entry into this world. Tell us about that.
Yeah, for sure. First of all, I love it when the New Yorker says Boston, right? Up here, it's Boston. It's flipping Boston from New York. Look, my journey into the position that I am today is pretty unique. I'm an immigrant to the States. You know, I have an affinity with the ghosts of Ellis Island, we'll call it that, coming over back in 1986. I was born in London, raised in the south of England, pretty much in the countryside, Cliff. Those beautiful English cottages and cows and sheep and all of that kind of stuff. And I grew up on a council estate, which is probably the equivalent of a housing development here in the States. Yeah. I didn't know we were broke. All I needed was a soccer ball and a piece of green grass, and I was pretty happy. But in 86, I was in college in London, not doing exceptionally well, to be honest with you. I was dating a lady from Long Island, and her visa ran out, and it seemed like a really good idea to emigrate, get married, and I intended to join the United States Air Force because her brother was stationed at Pease Air Force Base up in New Hampshire at the time. So, yeah, I came in on a fiance visa. I got sworn in Faneuil Hall in Boston about 3 years later as a naturalized citizen. So, carry an American passport today, my friend. Very proud to say so as well.
Excellent. Yeah. It sounds like your prime motivation was wealth building. Talk to me about when and how you shifted from wealth building to wealth management.
Yeah, great question. Look, if you can't take care of your own house and your own household, you can't bring service to anybody else, right? You have to practice what you preach and, deliver on the processes that have been successful for you as an individual in real estate. So, wealth building over to wealth management. For me, wealth building was a necessity. I had spent, like you said in the intro there, 16 years as a firefighter and a paramedic, but I'd also, come to this country with a very blue collar attitude. So I wasn't versed in finance. And it's predatory. Credit card debt, collegiate debt, lack of financial intelligence delivered to the generations behind us. And I was a victim of ignorance. And, I found myself in 2000 and late 7, early 8, working way too many hours, probably about 120 hours a week, trading time for somebody else's money. Creating wealth for somebody else. And I just needed to make a decision. Was I going to crumble? Are you going to fold under questioning, Henry? Or are you going to step up and step into something else? And that's what I chose to do. So that's how I started to create wealth for myself, was through real estate. And again, as you said in the intro, I found myself transacting millions and then tens of millions, and those zeros have increased throughout my career. But of transactions of real estate, I became very fluent in distressed asset management and repositioning right here in the state of Massachusetts. partnered up with Martha Coakley's office, who was our attorney general at the time. And she was vicious around the abandoned housing initiative, was her personal baby, if you will. So we aligned ourselves with her office and just got really engrossed in repositioning the assets, which obviously were great for the community. We got to jump the lean position on Bank of America, which was quite a pleasurable experience, if I may say so myself, to be able to hold the large financial institutions accountable for their actions. So we did that for many years, creating wealth for myself. And then as the career has progressed, it was a natural transition through my own portfolios of commercial real estate, my own, in-house portfolio, to then start looking at, managing wealth for other people, which has been a very interesting journey, to say the least. But it's a progression. I'm not really good at doing the same thing over and over and over again. I like a challenge. I like to be challenged. I may not be an academic, but I hunger for knowledge and, stepping into the next phase of whatever it may be for me. And by association, in wealth management, we're very blessed to be able to pass, our skills down and do great works with other people's capital and being that fiduciary I always say I'm just a steward of somebody else's money. I got a responsibility to sleep well at night. So, coming from a poorer background, I think it wanes towards, it just leans into the fact of if every dollar that goes out is represented as if it was my own. And, when $50 in the bank was a good week, you look at things differently than maybe some of our competitors that are out there. So I don't know if that answers the question, but
no, it does very, very well.
Transition.
Well, think about it. You go in and you're very, very deep where you're passionate about the investor at this point.
Sure.
You got assets under management. You got a fiduciary responsibility for those that are investing with you. I've run 3 companies and I've had this similar thought process, because I do revenue sharing with my teams, my employees.
Yeah.
And, when they spend money, they're spending their own money.
Right.
So we're all sort of, aligned to the end, and you're aligned with your investors. And it's a very, very positive way to look at what we're doing at this point. And it's the future at this point as these systems get smarter and we're able to actually measure how the performance is, but the ESG and other opportunities. So you hit a couple of positives when you're up in, I call it Boston.
Yeah.
When you look at some of the distressed real estate, you're stepping in and you're making some investments and you're bringing things up to, let's say, code market value at that point, and it creates a revenue stream for you and the community. I just salute you for that. I mean, that's a breath of fresh air where you look at, you're part of a community and you're actually investing in the community at this point.
No, I appreciate it. And it's nice to have somebody recognize your actions in a positive way. I look at it, and I had this conversation last night. I was at dinner at 15 Beacon in Boston. There's a beautiful restaurant in a little boutique hotel there. And I met with an investor, and we were talking about, there comes a point sooner rather than later in everybody's career where we start thinking about the impact that we leave, right? Whether it's our personal impact on our family, our children, our wives, the people in our immediate circles, and then also that community impact. And then and for us in money management, it's such a blessing because there's nothing more powerful or more rewarding, I would say, when you're, managing a self-directed IRA or a solo 401k from an investor who's entrusted us with, $500,000, 250,000, whatever the number is, of that hard-earned, not easily earned, but hard-earned capital that they say, you know what, I want to diversify. I like real estate. I'm still going to my job. I need somebody who's an expert. They got that 10,000 hours of, in the trenches moniker attached to their skill sets. So when you get that response back from them of gratitude, it changes people's lives. And it sounds so corny, it changes people's lives. Well, it does. It really does, and there's testimonies and testimonials to that. So look, I can't go into burning buildings anymore. This body's a little beaten, right? After 16 years, carrying, folks from the 3rd floor down to the ambulance, et cetera, et cetera. That's an immediate impact where you can see a result. A medical emergency or a fire, whatever the case may be, car accident, calming people down, taking care of kids. It's immediate. But in money management and the world that we get to circulate in today, I got a long-term impact. So those decisions are not any more serious than they were in that 911 scenario. And you and I were talking before we started the show. We've got that association commonality in the fire service there. But in money management, you're definitely responsible for not just the generation of the money that you manage, but the generations that come behind it. That's a heavy weight to bear. So the decisions are absolutely critical. We don't make any decision lightly, and the impact, upside, great stuff.
Are you spending time, you have a high net worth individual, they're investing with your fine team.
Yeah.
Are you working with any of their children at this point in time where they're the next generation? To help them grow and mature and understand, some of their impact they could make at this point through your fine investing?
Yeah, I was just in Chicago 2 weeks ago, and our capital conduit partners, we brought a couple on, Karen and Alec, onto our team because of their relationships. And it's kind of interesting. So you've got this disconnect, if you will, or this separation. You refer to high net worth individuals, or we call them family offices, as you know.
Very good.
And that family office is either Gen 1, 2, or 3 most of the time.
Very good.
Right? Gen 1 came over from Egypt, they came over from Greece, they came over from Italy, they came over from, Israel, wherever they came from, India. And, that Gen 1 not took advantage, but realized the opportunity that America had to offer and didn't take it lightly, right? Really buckled down, found a way to bring value to themselves and their community. So then Gen 2 steps into that. And look, please don't take this wrong, anybody who listens to this, but Generation 2 steps into that with a modicum of security, I would say. The heavy lifting, we can say, has already been done. Now Gen 2's got that responsibility for growth, and they're either successful or they're not. They meet their benchmarks or they don't. But if they do, then Gen 3 comes in. Now, Generation 3 in this arena, they have the shadow, if you will, of Generation 1. And I find that, in high net worth family offices, high net worth individuals, if we're dealing with Generation 3, they are highly intelligent. They are highly optimized with systems and processes and everything that the internet can offer them to be successful. And then on top of that, they're motivated to create their own stamp on the family legacy. So yeah, we do work with them. And I found that, look, man, it's all about trust, Cliff, right? We know that. Can you build some rapport, some trust, proven execution on your business plan? Once you gain that trust, I find it very easy to work with Gen 3. The other advantage I have is one of our principal partners, Eric Wilson, our Chief Operations Officer, is 26 years old. So I can deal with the 50 plus. My partner Walter's good with the 50 plus. And then we kind of blend it in between. And Eric can get in there with the millennials and, have real good communication and connectivity, which is everything in business, right? People do business with people they like. So yeah, we're blessed to have the diversity in team to be able to communicate, for sure.
Thank you for sharing that.
Yeah.
What's the most satisfying thing about managing a private equity fund?
That's a great question too. Look, there's this, this image, if you will. People watch Axelrod on Billions, right? And, he's on Showtime and Axe is flying around and it's all cars, boats and leather coats and backroom deals and $1 billion wins and $1 billion losses. For us personally, that's all garbage, right? There's no cars, boats, leather coats. For me, the biggest satisfaction is in, as I discussed earlier, Cliff, my biggest satisfaction, my biggest joys with regard to the investors is hitting the numbers and being appreciated for it, right? Not being in a greed-driven environment, and yet we still chase yield, right? I have a responsibility to find that yield and hunt it. So we get this, I call it yin and yang in business, because where am I aggressive? I'm really aggressive on hunting the deal. And when I find the deal, work the deal, massage the deal, find that, that situation where the seller has got pom-poms, we've got pom-poms, and the investors have pom-poms. I mean, come on, dude. It doesn't get any better than that, brother. It really doesn't. And I didn't need to fly in on a private jet to make that happen. I didn't need to show a video of me in my Rolls Royce to make that happen, right? I just got a new vehicle. I'm still driving an F-150. Now it's a 2021 F-150, and I'm very happy with it. It's got a big screen and CarPlay, right? So to go full circle on it, again, it's that being a custodian, a steward of somebody else's capital, sleeping well at night, and still getting the firefighter rush. You know, let's be honest. It's an adrenaline rush, brother. When everybody else goes running out, we go running in.
That's correct.
And if you bring that to the deal, you bring that to the chase of the yield, and you get to, you know, have fantastic team members that underwrite as well as anybody from Harvard ever did, right? When you got team members like that, and then Walter, my chief investment officer, you know, started real estate in 1986. Well, that was the year I emigrated to this country. So don't tell me we haven't seen a couple of cycles, because we have. You know, everyone's a genius when real estate is going in one direction up. How did you do when it flattened and corrected? So that's the real joy of it, having that much experience in the team to not be fearful of what's next. Okay. Because as we know, fear is a thief. It robs us of opportunities. It robs us of execution. It robs us of new relationships. So that's the joy of this business today. I still get the rush, but I don't have to beat my body up to do it much. Maybe a little bit, but not so much, you know?
Very, very positive. The audience may not realize I'm a firefighter, an EMT, and a hazmat technician. I consider it a hobby as a volunteer. I'm not really that active, but it's something that I share with Dave.
No, look, man, watch this. I had to shoot over to Staples just now, right? I've got a little, this is probably 350 square foot office. We downsized everything during COVID. I got a little office above a coffee shop, downtown Village, just north of Boston. And no secretary, no staff, everything's Zoom oriented, right? We work tight and lean.
Okay.
But I had to, just to show you, I had to run over to Staples. So I run over to Staples, I get myself a new mouse.
Okay.
And that EMT capacity never leaves us, right? That identification. And as I'm driving back, it's 98 degrees up here in Boston today. And as I'm driving back, quick shooting back to be on the call on time with you, this poor old gentleman, man, he's got to be 78, early 80s, walking down the street, no idea where he's going, fully profusing, sweating, right? He's sweating like a crazy man, a little hunched over, but he's still moving. I just did a slow roll by, wound down the window. Hey, brother, are you okay, sir? Yeah. I said, you're looking a little rough there, my friend. You all right? How's the breathing? Okay. Oh, okay. No pain anywhere. No, I'm okay. All right, good. How far do you have to go? Oh, that's my house right there. I said, get inside the house, get a nice cool drink, and sit in the air conditioning for a while. Okay, thank you. It's like that doesn't leave you.
No, it doesn't.
It doesn't leave you. So, you know, whether a volunteer, whether full-time running an engine company in Manhattan, or, you know, running an engine company like we did here in Lynn, Massachusetts, it makes no difference. It's service-driven, right? Plus the adrenaline. So there you go.
You know, you come in and you have a very calmness to you from the fire service and the emergency services. You know, very little is new to us. And we have the predictive, meaning we understand what's coming next and the size up of what we're doing which leads me into my next question to you. You've said you make money on the buy. What does that mean?
That's, So look, real estate is a reverse engineered process, okay? Whether it's a buy, fix, and flip single family home, what can I sell it for? Minus repairs, minus carrying costs, minus cost of capital, you know, holding time, boom, does the deal make sense? So it's unfortunate that right now, even in our arena, in the commercial real estate, multifamily arena, there is so much capital, as I'm sure you're aware, in the market, that money in and of its essence does not want to sit still, right? If capital sits still, it's not growing. And if it's not growing, it's dying. So there's this huge influx of capital in the marketplace. So the buy side equations have got really screwed up. I'm just going to be very direct with it. It's a shite show out there right now.
Okay.
Because, you know, no offense to New York, but the New Yorkers are coming down with hedge fund, you know, commercial capital, billions of dollars, and that's not an exaggeration. And that capital needs to go somewhere. And, you know, these insurance companies, for example, have a responsibility on their payout and their yield, and they're just looking for yield. So they can take a 3% yield on the buy side, knowing that they're going to stay in it for 15, 20 years, whatever the case may be, hoping that rents will eventually catch up
Yeah.
and level out. Well, that's okay for them, but it's not okay for me.
Mm.
So my buy side has to be fantastic. It has to be right. So when we first started at Freedom Venture Investments with our fund structure, we had a very succinct buy box. 50 to 150 unit complexes, Gulf Coast region of Florida, where our teams are established, looking for core plus assets, core meaning cash flow, plus meaning a chance to reposition, targeting out a 6% preferred. And then with the repositioning, we get into maybe a 10 to 12% cash on cash quarterly distribution, 2.4, 2.6 multiple over a 3 or 5 year hold. That was our buy box. And so far, so good. But they changed the rules and they bought in all this cheap money. So, for us, it's like, what do we do? Do I now put my investors' capital in there at a 3% yield? No, can't do it. Not going to do it. Could I? Yes. Will I? No, never. So I have to create a new buy side of the equation because it doesn't matter about the sell side. The sell side will come. Real estate has always showed me that if you buy right, your exit's going to be okay. And do you then have multiple exit strategies? So for us, what we did was we then squeezed down our unit count, and I'll buy 8 units. I'll buy 20. I'll buy a 16. I'll buy a 12. I got a 13 unit deal in West Palm Beach that we just locked up for $2 million. Need to do a little adjusting on the pricing because of wasn't quite the rehab that it was projected to be when we walked the property. So we'll work the numbers a little bit, but even on that one there, that's going to end up being a 7.5 cap on the buy side in a marketplace that could trade at a 5. That helps my investors. So I'll do 10 of those instead of looking for one 100 unit complex, but I can only do that if I've got the rest of the variables in place, the property management, construction, etc., to be able to execute on the plan. And I say this all the time, Cliff. Please. The Wall Street money's coming in. It represents the Titanic. It's big, it's bulky, it moves slow. We come in and I'm like in a little speedboat, because I run a lean, tight ship. I'm able to move, I'm able to adjust. We create opportunity and hunt yield. And I'm not in that position where I have to spend money, which is actually an advantage in this market right now. I've got a peer out of Philadelphia who brings in approximately $45 million a month in private equity, and he has to put that money to work. How do you do that? I mean, I couldn't do that. So it's definitely an interesting time. So that's what I mean when I talk about, we make our money on the buy side.
Very good. You're very strategic at that point in time and really understand the long-term value.
You have to be.
Very good.
I don't understand Wall Street. I don't understand stocks and bonds. It's never been my wheelhouse. Commodities, short, long, all of that. I've never understood that, but there's a strategic play in every investment, right? There has to be. Otherwise, it's just, let's all just go to Vegas and throw it all on black or red. So we're positioned. That's what it's really all about. It's a positioning to be able to execute on the right deal at the right time, no matter its size, as long as it's meeting our buy side criteria, which is really our sell side criteria.
That leads me very, very well.
Yeah.
You also said your story, your greatest asset in becoming a teacher in real estate investment space. Talk about that.
Yeah, look, that journey from England, 1986, I emigrated. So I'm probably more of an American. I'm more of an American than I am a Londoner. But I came from a very blue collar background. I mean, my father was a heating and air conditioning guy. My mom was a secretary in a local bank. As I said before, we didn't know we were broke, right? But with that, it's that middle class of today, that working class of today that has been, in my opinion, abused. I know what that felt like. In 2000 and late 7, early 8, when I started in real estate, I was also suffering the consequences of financial ignorance because I had refinanced my house 3 times, I think it was, in 18 months. Because an attorney friend of mine said my house was an asset, it would never go down in value. You work hard, get all the money out. Well, we all know what was going on with, collateralized debt obligations, and Jamie Dimon did okay. Dave Seymour got a little bit hurt back then. You know what I mean? So having those scars, having that trade time for money mentality, when it comes to excuses, there aren't any anymore. And you know this as well as anybody in the private equity space. We look for excuses, right? We look for reasons why something won't work. And what that does is it allows me with a firefighter background, so you and I know what a real emergency looks like.
Sure.
My partner Walter was Special Forces serving our country for 16 years.
Excellent.
He knows what an emergency looks like.
Right.
He knows what a life-threatening scenario looks like. So we're able to look at excuses and with respect, re-educate, redirect somebody's, I call it stinking thinking. Like, you know, every decision we make is based off of some prior experience, right? So until we experience potential double-digit returns from a commercial real estate investment that was passive, that they didn't have to go collect rents, you know, until somebody experiences that, we have a responsibility to share how it works, why it works, where it works, you know, what are the components, the verticals of a good deal to execute. So, you know, my past brings that, it's guttural. It comes from my guts. You know what I mean? It comes from my core to be that warrior for right. I mean, it sounds bizarre, but that's who I am. I'm not going to change. Other people's opinions of me are none of my business. You know what I mean? It gives me a nice freedom to go out into the world and do the best I can. But, you know, all of those past experiences, I believe them to be assets for what we do today. It's not collegiate degrees. You know, I'm not from Yale or jail. I'm not a Harvard graduate. I got a fire science degree. I know the mechanics and the chemical breakdown of hazardous materials. I'm my NIOSH guy.
Okay.
Right, your NIOSH guy. But bring traction to what I do, because that's the only way I got where I am today, by putting my feet on the street. Excellent. Not just by reading a book. So I think that that correlates to an investor who's looking for somewhere to get some, you know, response, some connectivity again with us going forward. So I hope that answers the question.
Very, very well. Well, you're spending time to educate those investors at this point, or prospective investors.
You have to.
Then
you have
you have a strong team in place on the financial, the operational side, and then hyper selective in what you're acquiring, knowing we got to buy it right. So you have a positive piece of cash flow that goes out to the future, and then there's an exit at that.
Yeah.
Tell me a little bit. You say that commercial real estate is directly correlated to retail. Explain what you mean by that.
Yeah. So if you look at the cycles historically, retail real estate. When I say retail, I'm talking about single family. You know, Mrs. Jones sells, Mrs. Smith buys. They move in, they move out, they move up, they move down. That retail environment. There is a correlation, and it's basically, I think the last statistics looked at it was somewhere around 12 to 18 months. You begin to see a correction primarily in single family. And then 12 to 18 months after that, you start to see a correction in the commercial arena. Okay. So you know this, man. We're all data driven. I wish we weren't, because, you know, data makes my eyes bleed. It makes me fall asleep, which is why my team crunches all those numbers. But we start looking at data. And if you're watching what's going on, this is our first notification of a reduction in new mortgages. We've maxed it. We've maxed it out, man. The prices are too high. The capital, it's there and waiting, but, you know, nobody can afford it. I mean, it's ridiculous. You can finance a brand new vehicle now for 8 years at 2.5%. I'm like, when did you start financing cars for 8 years? Nobody can afford them. Nobody can afford them. So when we start looking at that, I'm now beginning to dial in the next strategies, and it plays in. It's almost like it's a playbook. Because this big money that's coming into the marketplace right now at a 3%, unfortunately, that's going to be a loss for somebody. And because it's a loss for somebody else is going to benefit from that misaligned position that they put themselves in X amount of years earlier. So, you know, I know that the single family market is going to correct. You know, COVID has played a crazy variable in all of our intelligence. Sure. All of our predictions and our, you know, all our modeling that we live with. But, you know, just knowing that one will follow the other is a big part of how we underwrite and decide where, when, who, and how. That's what I mean by that.
Let's build on that. What are your perspective on the long-term effects of COVID on the commercial real estate space?
For some people, excellent. For other people, not so good, right? Not so good. It really is, man. It's fundamentals. Buy right. Buy right. The deals that I could buy, I want to say just 12 months ago, 1 year ago, right? COVID was March, April, May. So May of 2020, I could buy beautiful multifamily assets at a 7 cap. And we did great with some of that. Reposition it, get the 10 to 12% cash on cash. We've been successful in delivering, at targeted returns. But what's so interesting is to now see that change, that huge change in the commercial marketplace. So what does that mean for us long term? It means it's kind of like Braveheart, the movie. Hold, steady, hold, now go, right? And we're just waiting for that go signal. Now that go signal, I believe, is going to manifest itself through a couple of triggers: the moratorium and the moratorium on the mortgages. When the banks say, okay, enough is enough, I don't care what anybody says anymore, it's time to start paying your mortgage, catch up. That's going to create some obvious changes in the single family supply and demand marketplace. And then on top of that, the landlords who have been brutalized, in my opinion. All right. We live in a society that says it's a transfer of goods and services, right? That's how we operate. That's who we are. And to be able to be in that position that, a landlord cannot collect rent, cannot evict, is incredibly dangerous. And I get it from the social perspective. I'm not a bad guy. I'm trying to find the best scenario in a really crappy situation. And I don't know that I know the answer to that either. I'll be very honest with you. I'm not an economist, but to be put in a position where those smaller assets, multifamily assets, have not been allowed to collect rent or clear out the tenant who has been unable to pay rent, it boggles my mind. The same rules don't apply in Texas. Same rules don't apply in Florida. Those markets are, your red and blue states. So to answer your question more succinctly, it's going to be great for us because we only pull the trigger when the deal makes sense. And there will be distressed assets in the marketplace. Our team at Dickinson Wright, which is one of the largest distressed asset legal firms in the country, they're on retainer with us. I'm just waiting for the phone call, waiting for the Chicago office to call and say, okay, you want notes? Do you want singles? Do you want multis? Do you want commercial? What do you want? So we're waiting for that shoe to drop because it has to.
It cycles when you see it.
Yeah, for sure. Pandemic, no pandemic.
Very good. We
were still going to get cycles.
Excellent.
Pre-COVID, the increase in value was ridiculous. So, then I've got a real good friend of mine down in South Carolina, been investing for probably 40 years down there. He's pretty famous in his area in Charleston. I went down to visit. I'm looking at some land and some deals down there with him. And he said to me, he said, what is happening right now, he says, just feels like it felt around here when Hurricane Hugo hit Charleston.
Okay.
I said, well, what do you mean? He said, brother, it's a false economy. He said, when Hugo hit, in came all the insurance money. People didn't have a house because it got knocked down, but they had a brand new Escalade. He said it was a fake economy. It was false. There was no fundamentals attached to it. He said, this just feels like the whole country got hit by Hurricane Hugo because of all the capital that's been, infused into the economy. So, every action has an equal and opposite reaction.
Well said.
Will you be a victim or a victor of circumstances, right?
Well said.
It's that opportunity moment. So that's how we predict. That's how we work as a company, to hold, steady, hold. Okay, go, baby, go. So that's how we look at it.
What makes multi-residential real estate investing an attractive alternative to the stock market?
Yeah, great questions. So in our fund structure, for an example, it's an illiquid investment. Once that capital is committed, it's in. Now, I spoke to, and some people would say, well, that's a negative, right? My capital's trapped, if you will, for 7 years. Oh my God, I can't get it back. Now, that's a positive or a negative, depending on your investing mentality. A mature investor will look at that and say, okay, that money is a workhorse. It goes into commercial real estate and it works.
Mhm.
3% rent increases. Oh, I only got 2% this year on a rent increase. Don't worry, we got next year. Next year is going to be a 5%, whatever's going on in the marketplace. Reduce expenses, reduce debt service, increase NOI, increase value. It's been proven year over year over year. It's a Clydesdale.
Excellent.
You know, it's not sexy. It's not the latest stock, right? So a mature investor might look at commercial real estate and say, I'm going to diversify into that. I want some workhorse as well as the potential stallion of the stock market, to use, you know, the horse analogy. Well, what's the stallion of the stock market? It's the latest, greatest tip. It's, you know, listening to Munger and Buffett, you know, sitting there, Warren Buffet and Charlie sitting there. I recorded their delivery. I haven't watched it yet, so I'll be interested to see what they say. But, you know, they took the world of the stock market and business and almost created a workhorse environment for that, if you think about it, because of that longevity, that time. But if you were investing in GameStop recently, you might have taken some bumps and some bruises.
Mhm.
So I talked to some guys that I know and some ladies that I know, and I don't ever want to be just throwing crap out there that doesn't make sense. And I said to them, what is the 15, 20-year yield on an investment that somebody makes in the stock market? And take this with a grain of salt. Say I'm crazy, call me a liar. I'm just responding to the information that I asked for, and this is what I was given in return. They said the average investor in the stock market is probably yielding out over that period of time anywhere between 3.5% to 4%. And I said, well, what? That's not right. They said, you asked me for my answer. That's my answer.
Mhm.
I said, well, you know, everybody knows the stock market gives on average a 7 to 9% yield. Everybody knows that.
Mhm.
He goes, yeah, that's the best yield. That's the person who puts it in the fund and leaves it alone.
Okay.
He said, the problem is this. One, fees. Every time the money goes in and out, it's got a fee structure attached to it. And number two, money going in and out, in and out. People have yet to figure out, and it boggles my mind today. Look at you, you got me all worked up. People have yet to figure out that compounding returns are only a beautiful thing if they are not brutalized by compounding costs. And that, my friend, is why I look at the difference. In commercial real estate, you're going to pay a 2% one-time fee on the acquisition side, and you pay a 2% one-time annual fee for all assets under management. Other than that, every line item for actually working that business is included. And here's my other point on this. And I don't know whether it's aligned with the question, but I think about this often. You take a company like us, you invest $500,000 in a 401k plan, for example. You can call us. You can get the CEO on the phone. You can get the investment team on the phone. You can have intelligent discussions pretty much whenever. Like I support our investors. I would just like anybody who's invested in the stock market to tell me the last time they had a conversation with the CEO of just one of the businesses that they're invested in a mutual fund or whatever is out there in the marketplace. So, you know, it's personal, man. There's no right or wrong, in my opinion. It's just left or right. You know, we offer diversification. We offer a workhorse. We offer a long-term investment strategy that, and I can say it in full disclosure, SEC compliance. It's a proven track record that has consistently outperformed all other investment vehicles in the marketplace.
That's the magic.
I don't know. I like that. That's my wheelhouse. That's my sticks and bricks, as we call it. So, yeah, those are the differences in our opinion, as we look at this stuff. Yeah.
What will be your personal legacy, and what do you love about what you do, and what do you find most rewarding personally, Dave?
I always have this vision, right? If you look at the Seymour family tree, I want it to be that it goes up and then it gets to me and they go, that was the guy that changed the trajectory, right?
Okay.
And I don't say that for ego. I don't say that for accolades or anything of that nature. I say it because, I have a responsibility I have sons. I have a 26-year-old son from my previous marriage. And the good Lord decided to bless me at 54 years old with an 11-year-old and a 9-year-old son and a fantastic woman who holds everything together, right? My wife, Mary Beth. So that legacy, if you will, is that, the Seymour generations after me can step into Gen 2, Gen 3,
Very good.
kind of what we were talking about. If I can leave that legacy, the most important job in all of this is to raise, boys to be great men, to be great husbands, to be great fathers, to be great brothers, to be great partners, in their relationships in life. So, that's a legacy. If I can sit on a porch somewhere in a rocking chair in a cardigan sweater and, have my sons just drive by and give the old man a thumbs up. That's all I want. That's all I want. I think that's a legacy for me. And, the joys of that is watching the influence that it's almost unintentional. Like I look at my kids, my younger sons, they're absorbed with YouTube and being gamers and all of that craziness.
Mm-hmm.
And I try and resist it as best as I can and, parent it. But, when I've got a 9-year-old kid who says to me, Dad, we need to design a logo for my merch. I'm like, what are you talking about, Bennett? It's my merchandise, Dad. We're going to design a logo. My company name is Phoenix Blade Gaming.
Okay.
Jefferson is Cool Jeff stuff. His logo is a controller.
Mm-hmm.
He's like, we're going to get some T-shirts. We're going to sell them. And I'm like, okay. And I give my kids a marketing plan. I buy 2 boys, 10 T-shirts each, and I tell them, you're going to sell them at a loss, but on one condition. Every one of your friends that you sell them to all have to wear them at school on the same day. Why? I said, well, think it through. Why? Dad, exposure. Everybody sees it, and now everybody's going to want it. Genius. I mean, my father never told me that stuff, Cliff. So that's my legacy. If he works at McDonald's, flipping out fries and burgers, and he's happy, I'm okay with that too. I really am. I mean that sincerely, but I don't think that's going to be the case. I think he'd rather own 10 McDonald's than work in one, So that's a legacy that I could be proud of. I'll hang my hat on that one.
So you have high expectations for the kids, and you've shared those values with them.
Yeah.
Have you taken them to share some of the real estate that you own at this point? It could be drive-bys.
Oh, for sure.
Right.
For sure.
Very good.
Oh, look,
See,
man.
That's positive.
Look, my guys, my kids.
Yeah.
So I'll still do a single family deal if it comes on my radar and the numbers make sense. Jefferson and Bennett had career day.
Mm-hmm.
And Bennett went to school in a 3-piece suit.
Okay.
And he had a little handkerchief in his collar, in his jacket pocket.
Sure.
And he's funny. He says to me, Dad, I want to wear some handcuffs in my shirt. Okay. I go, handcuffs? I said, what do you mean handcuffs? Cufflinks is what he's talking about. Yeah. He called them handcuffs. Okay. But he went as the CEO of Vilcorp. And I said to him, what does the CEO of Vilcorp do? And he says to me, Dad, he's a real estate development guy. We buy apartment complexes.
Very good.
And I'm like, really? Where do you buy them? He said, only in the markets that make sense. So even if he's not I'm in Boston and we're buying in Florida, so he's not physically on those properties. But the properties that he did grow up on, both Jefferson and Bennett, here's the simple stuff. They walked onto properties that I was rehabbing back in the day when they were little. They'd see the guys busting their hump. And they go over and grab waters out of the cooler for the guys. They'd like, hey, Dad, why don't we get the guys some sandwiches and some lunch? Like he understood there's no better than, there's no hierarchy in business. We're a team, man. Let's go to work together. You know what I mean? So definitely had that exposure and reaped the rewards from it for sure. For sure they have.
Well, they're listening. That's really the magic at this point.
Even when you don't think they are, Cliff, they're always listening, man. They're always paying attention to you. So, raise good little boys to be great men is the charge for sure.
Dave, can I share your contact information with our listeners?
For sure. Yeah, you can.
Thank you for that. You can reach Dave Seymour by email at info@freedomventure.com. Again, that's info@freedomventure.com. Dave's phone number is 781-922-4418. Again, that's 781-922-4418. And Dave's website is amazing. It's got a tremendous amount of education, and I think you'll enjoy that. And you can also contact him through there. And that's freedomventures.com. Again, freedomventures.com. Thank you to our listeners. I look forward to being back with you shortly for another episode of the Private Equity Profits Podcast. The show has been produced by Market Domination LLC.